I think we have people not only from Indian Rockstars community, but also from outside. So I would like to just tell one, two liners about the Indian Rockstar. So the Indian Rockstar name might sound different. We are no one is a musician here. So we are all a group of individuals which with a similar interest or roles, whereby we are most likely tech people, startup people, founders, investors, digital marketing. So that's the kind of crowd we are. We started this in 2000 during COVID time, 2020, 2021, and now we are about 700 plus people. That's the strength of the community. Yeah, and we have a LinkedIn community also, Indian Rockstars. It's a group, and then we have a website, indianrockstars.com, and we are there also in a WhatsApp. So, just that is what we are. And probably today's session that Mr. Loganathan and team is going to talk about is NRI, the NRI living in Indonesia's taxation and FEMA compliances on Indian income. Many people might have several doubts on this topic. So we have a few people, there's the speakers of the day. To start with is Mr. Loganathan Anandan, and then we have Miss Vinuta and Mr. Rajesh and Bapak Indra Gunawan and Mr. Ashish Jain. So most of them are senior chartered accountants. Some are based out of India, some are based out of Indonesia, and both of Indian and Indonesian mix we have. So thank you so much for this session arranged by Mr. Loganathan and the team. We are glad to be part of that, and I hope it will be beneficial for everyone. So with this, I hand over the platform to you, Logo. Please kindly take forward.
Thank you so much, Mr. Prasant. Really appreciate it. Okay. Selamat sore, namaste, vanakkam, vandanam, suswagatam, and welcome everyone. Many thanks to the Indian Rockstar team and especially to the founders, Mr. Prashant Iyer, Mr. Bipin, for this social events online and offline. Perhaps this is the first gathering or event by Rockstar without holding in our hands any drinks or snacks. So sorry about that, but we are going to make sure that in the coming days we will make that also get fulfilled in the similar manner we used to rock the community. Just give me a minute. Okay, start joining. And special thanks to His Excellency Sandeep Ji, who personally sent us encouraging words for this kind of session amongst our fellow Indians. So we keep coming up this kind of session, knowledge session, so that we are not missing any deadline, not missing any compliance, everything within a legal framework boundary we are doing things. Yeah. And yes, sincere thanks to all of you being Saturday evening chosen to be here rather than having a lunch or nap. This shows the level of importance to the topic and timeliness, as a lot of us keep getting the notices from the DPJ, Kantor Pajak in Indonesia for various reasons on our income in Indonesia and India. So we have a lot of things to discuss within the 60-70 minutes, followed by a Q&A session. Let me not delay the session to start. Some housekeeping rules. Q&A session is scheduled towards the end of the presentation after the speakers given their notes on various aspects. However, having said that, if you have some pressing questions, you can type it in the chat box. And we have Farhan here and myself can type the answers spontaneously. If there are still anything left to be answered, we will get back to you with your email ID. We have got you covered. And another important rule here, the second rule is, the last one is, don't provide your financial data, PAN number, or passport details, or your asset details in India. I mean, I'm living in BTM layout, Bangalore, or something like that, because this session is getting recorded at the interest of so many people out there were not making it today. So this will be recorded and curated and uploaded on YouTube for the other Indian NRIs interest. Okay. Okay, well, quick questions just to clarify a few things. Why this webinar, not ChatGPT or Google? It's obvious, right? I mean, when you ask specific questions, these tools will give you a plethora of information you have to choose from. And you need somebody to handhold you to get the right answer. And we don't have all the time in the world to read, comprehend, seek assistance, and act. So here we come up with a gist of what the pain points are and make it a 60, 70 minutes capsule and ready to consume right away. And you bet it. Uh, how many of you have your savings back at home only in FDs? A quick show of hands. Only FDs. No other investment or no other. Okay. We got about 5 to 10 percentage of the crowd here. And I won't say conservative, but that's a conventional way we taught be. In that case, after this presentation today, you will either change your mind, choose to invest in alternate investments to maximize your returns, not to stick with just 8 to 9 percentage. I mean, 9 is pretty high, but 7 to 8 percentage interest, but you can have multiple investments, especially from India. And there is a quick disclaimer. We are not associated with any fund house or any of the mutual funds or financial institutions to get commission out of the investments, but we are just, this is purely a knowledge session. So rest assured that this is for the benefit of all our community members here. Okay, let me get into the main, main session. Just give me a minute. Is the screen visible? Okay. So just a quick intro of the speakers of the day. I myself, thank you, Prashant, Grace's introduction. I'm basically Indian CA and public accountant and CISA. And we have Vinuta, who is a practicing corporate secretary, a member of ICSI with specialization of transaction advisory, Forex, FEMA, and secretarial, MCA, and RBI related stuffs. We have Rajesh, based out of Chennai, India. Is a seasoned professional with 17 years of experience with expertise in litigation support, transfer pricing, and tax optimization and M&A. We have Bapa Indra Gunavan, is an expert in Indonesian taxation law, and he is ex-DGP person, and he knows practically how to handle taxation in Indonesia. And we have Ashish Jain, a master in expat taxation and cross-border international taxation, and how to get your tax credits and how to lower your taxes when you have income in India. All those things will be explained by Ashish. Okay, here is a quick overview of how the coverage of entire presentation is made. First is Global Investment Hub in India, and intricacies of FEMA and FDI, ODI by Vinuta. Impact of Indian income tax income tax on investment in India, special tax benefits to NRI and PIO related compliance. And Bapa Gunawan will take care of tax regime in Indonesia and treatment of foreign sourced income in Indonesia. And finally, double DTA analysis and the foreign tax credit for NRIs in Indonesia. Okay, a quick overview, as I mentioned before. Apart from the FDs, we usually make, we are conventional being Indians. There are quite a bunch of opportunities for India for looking at the various economic upside these days. So by 2027, we are going to be the third largest economy and third largest stock market by 2030. So that's a tremendous growth we are seeing now, and we are on track to reach 6.5% growth in the fiscal year. I mean, current fiscal year. It's happening right now, and might hit 7% in 2026, according to the latest estimates. And no, unlike other timeline, now it's a compelling foreign investment hub right now, which is also set to overtake China's growth of 5% in 2024. Again, it's right now. The startup ecosystem in India is the third largest ecosystem, and it ranks second in innovation of quality, with top positions in the quality of scientific publications and the quality of its universities among the middle income economies. I mean, I've seen many of our Indonesian friends also sending their kids to India for higher studies. I mean, that itself a testimony for us. And why invest in India? Indian stock market provides a lucrative avenue to invest in a risk-reward ratio at a much superior level in comparison to various world indices. In India being the fifth largest stock market and the market capitalization, a huge opportunity in the leading economies in the world. I mean, I keep telling to my clients and friends, like in 2022 or 2023, Indian stock market give phenomenal returns. Unless somebody is resolved to make loss voluntarily, one should have not made any losses in the 23 stock market. So that's a powerful and testimony for Indian stock market. An indicative table of average return among global indices are just given here. So you can witness between 10 to 12% is the normal scenario of returns in the last 10 years. And last 2 years, it's super abnormal, beating this statistic itself. Okay, there is quite a bunch of asset class which constantly surpassing the benchmark of returns in real estate. Especially, you will be able to, you are surprised to get to know that the returns from stock market and mutual funds are surpassing your rental income. Real estate is, sitting behind than stock market and other mutual fund investments. Okay, having said the super abnormal, unusual profit-making stuffs, this comes with a package also. So you need to be clearly understanding the compliance comes along with these benefits. So that's what I mentioned. It's a capsule of presentation and the knowledge session today, where you can get to know how to make most out of our income, our investments, our savings. At the same time, how to comply the comprehensive regulations and tax matters to take advantage from. In conclusion, investor considering investment in Indian assets must think through various aspects of regulatory requirements and taxation laws to make safe and practical investment decisions. And again, before I hand over to Vinita, I just wanted to stress, like, this is mostly towards investment for individual as well as firms set up from abroad. So over to you, Vinita, and all the very best, guys.
Thank you, Loganathan. Yeah, thank you. And I would like to talk upon the various foreign exchange laws that are applicable to investments in India, and we'll also be talking about investments from India, that is into other countries from India. So we start with investments into India, which is nothing but inbound investments, and it is termed as foreign direct investment under the Indian legal language. So we have the foreign direct investment policy, which is issued by the government of India, and which is regulated heavily by the Reserve Bank of India through non-debt regulations. So Yeah. So investments can be in either you could invest as FDI into unlisted companies in equity instruments, or it could also be in listed entities up to 10% in the form of equity shares. Now, when we say equity instruments, it is important to know what is equity instruments. Equity instruments are nothing but equity shares, compulsory convertible preference shares, and compulsory convertible debentures. Any other form of or nature of instrument that is issued do not qualify under FDI, and it would be governed by other laws, could be the external commercial borrowing laws or any other such laws. So FDI can again be under automatic route. There has been liberalization over the last few years extensively, and there are only few sectors which are either prohibited or regulated. Where it is a regulated sector, then probably the government of India approval would be required. We will have a look at the in sectors in our next slide. And foreign investment is in a limited liability partnership has also been permitted, but it doesn't qualify to be a foreign direct investment. And they're a little different from the foreign direct investment guidelines. Foreign investments is also permitted only in LLPs where the LLP in India is only under 100% automatic route. If there are any other restrictions associated to that sector, then the LLP cannot receive foreign investments from abroad. Moving on to the next slide, which is talking about the various sectors which is defined under the foreign direct investment policy in India. We have certain sectors wherein FDI is prohibited, something like the real estate, where it is buying and selling buying and selling real estate properties. It could be lottery or cigars. That's a small list of sectors where it is prohibited. Then there are certain sectors where it is restrictive. It is permitted up to a certain level of investment, and subsequently it would require approval from the government of India. Telecom sector where it is permitted up to 49%, and then it requires 74%, and then it requires further 100% approval would be required from the government of India. So we have multi-brand retail where it is permitted up to 51%. And other than these, if there are any other sectors which is not classified under prohibited or permitted with government approval, they fall into the residual category wherein 100% investment is permitted. Right? And there is also a recent caveat that has been brought in 2020, wherein investments from countries or where they are sharing land borders with India, such countries are required to take prior government approval before they invest into India. Yeah. So while investing in India, we need to know a certain terminology because that decides how we are going to invest, what are the restrictions and what are the conditions that would be applicable to us. One is, of course, a person who can invest. So it is either a person resident in India or a person resident outside India. Now, person resident outside India has been defined as a person who's not resident in India. Now, who's resident in India? As per the Foreign Exchange Management Act, a person who's staying in India for at least 182 days in the preceding financial year is considered as a resident in India. But if he has left the country to take up an employment or for any other reason and for an uncertain period, then he is not considered as a person resident in India. Similarly, if a person has just come to visit India, he is not considered as a person resident in India. A person resident in India also includes companies which are registered under the Companies Act or incorporated in India. Any branch of a foreign company or an agency which has a place of business in India is also considered as a person resident in India. It is also critical to know the definitions of certain accounts that are that play a relevant role in deciding how the investment has to be whether it will be on a repatriation or a non-repatriation basis. So some of the familiar accounts, which I'm sure all of you will be familiar with, is the non-resident external rupee account, which is NRE account, foreign currency non-resident account, which is the FCNRB account, and the non-resident ordinary account, which is a NRO account. So these accounts play a vital role to decide how your investment will be treated in the future. Okay, so when we are talking about the various ways in which funds can be brought into India by the different categories we just spoke, here is a summary of how it can be brought in. Okay, so when we are talking of investments that are being made by a person resident outside India, when I say investment, investment could be either by way of allotment of shares, or it could be by way of an acquisition or purchase of shares from another shareholder. So when a person resident outside India is investing in India, then the invest funds which have to be brought into India have to be brought in either through the normal banking channels, that is from the country in which from which the investment is being received through the bank account into the bank account of the company, or if it is from India, it could be from the NRE or FCNRB account or an escrow account open for a specific purpose for issue of shares. Okay, so investments made in this manner are generally on repatriable basis. When we talk about repatriable basis, it means that any transfer or sale of these shares which have been purchased can be transferred to other residents or non-residents, subject to whatever conditions are applicable, freely without any approval. Okay, when it's non-repatriation basis, it cannot be transferred to any person outside India. The investments and the dividends will have to remain in India. Moving on to the next category, which is investments by non-resident Indians or overseas citizens of India. When it is on repatriation basis, the funds have to primarily come in only through the NRE account or through normal banking channels. It cannot come in through the NRO account because NRIs generally maintain both NRE and NRO account. Then we have the third category wherein investments can be made on non-repatriation basis. In that case, you can use your NRO account in addition to the NRE and FCNRB account. And you decide to classify this kind of investment, even though you're using your NRE account, as non-repatriable shares or equity instruments. Now, if the shares are again on a non-repatriation basis, then those investments are not required to fulfill the conditions with respect to FDI. They are treated in par with equity by resident individuals in India. NRIs can also invest in the stock markets in India on repatriation basis through their NRE accounts. So that's how shares can be brought, investments in unlisted public companies can be made by NRIs. And when shares are on repatriation basis, you can freely transfer it by way of sale or gift to non-residents. Okay. Now, there are certain regulatory highlights which every investor ought to know. And of course, the companies in India are required to ensure the compliances. But as an investor, you should also know that these conditions would be applicable. One is, of course, the pricing guidelines. So issuance of shares or any equity instrument or transfer of these shares or equity instruments are subject to pricing guidelines, so which is prescribed by the foreign exchange laws. And when you're being issued any convertible instrument, it is also important that you arrive at the conversion formula or the conversion terms upfront at the time of issuance of such instruments. And these are again subject to valuation norms, which will also be important from the income tax aspect, which is further dealt with by my colleague. Okay, then moving on to the reporting requirements, although the reporting requirements is not required to be, it's not something which the investor has to worry about. It is the investee company or the resident Indian in the case of transfer. But it is important that any investor knows that the reporting requirements are completed well within time, acknowledged by the Reserve Bank of India, because that is critical for any investor when he has to exit from the investment. If these shares are not acknowledged, then exit becomes a issue. RBI does not permit exit of such investments. So some of the reporting requirements are shares which have to be for funds which have been remitted into India. Shares have to be allotted by the investee company within 60 days, else it has to be refunded. A form FCGPR with the AD bank, the bank through which the company operates, has to be filed within 30 days of allotment. And if it is on non-repatriation basis, then none of these, you don't have to worry about the filing of the form FCGPR. For the case of transfer of shares, then form FCTRS has to be filed by the resident Indian. That is when it's, whether it's a seller or buyer, within 60 days of the transfer of shares. Okay. So this was something about the foreign direct investment, inbound investment. Now we're moving on to the overseas investment, that is investments that happen through Indians or Indian bank accounts or resident Indians from India into foreign companies outside India. So again, overseas investment is classified either as overseas direct investment or overseas portfolio investment. Now, this classification has been brought in very recently when the entire overseas investments regulations were revamped by the Government of India in 2022. So ODI means any acquisition of shares in an unlisted company, or if you're subscribing to the memorandum of association of a foreign entity. Mere subscription of shares is also treated as an ODI, and all compliances trigger if you subscribe to the memorandum of association. Investment in a listed company of 10% or more is also considered as ODI. Investment in companies, and it could be unlisted companies, wherein there is your investment size is less than 10%, but you have control by way of controlling the board or any other agreement or management of the company, then such investments are also classified as ODI. OPI is investments which is other than ODI, which is generally without control and less than 10%. And when resident individuals invest in shares out of India, they have to comply with the LRS limits, that is the Liberalized Remittance Scheme. It's applicable only to individuals and not to corporates or any other form of entity. So LRS limits of which is presently USD $250,000 per annum has to be met with. You have to invest within that prescribed limit. And again, while the remittance is being made, TCS, that is the tax collection, so at source have to be complied with. Okay. Investments by, and there are thresholds how much a person or a company in India can invest. Now, if it is ODI, then it has to be within 400% of the net worth of the entity or the person or whatever. And then again, net worth is defined how you need to calculate it. If it is only OPI, then it cannot exceed 50% of the net worth. And like FDI, ODI also has certain restrictions in the sectors that you can invest. Like you can mostly invest in most of the sectors except real estate, gambling, and dealing in financial products related to the Indian rupee. And there is a financial sector, service sector, although it's not defined under the ODI regulations. It is more to see if that sector under the host country falls under the definition of a financial service sector. If ODI in such financial service sector is permitted, then there are conditions if an Indian investor wants to invest in such companies outside India. Okay. Then you can, like I mentioned, investments can be by way of subscription, investments can be by way of purchase of equity shares or any rights issue being made to the existing shareholders or bonus issue. If there are any dues that are there and you want to capitalize those dues, that's also considered as ODI, or any form of merger, acquisition, or any other structural changes by virtue of which you receive shares, it gets qualified as ODI. ODI has to be reported to the Reserve Bank of India in a particular form. Uh, Generally, it is done while at the time of remittance, and through your AD bank with a set of documents, which also in evaluation is required when you decide to make an ODI. After submission of the documents, when RBI scrutinizes it and issue confirms, you have to receive a unique identification number for your investment. So only when you receive that UIN, it means that your ODI compliances are complete. So if we are not able to meet all these requirements, then the ODI is not approved. And if there's a delay, then generally there is a penalty associated with such non-compliances. The other interesting concept that everybody talks about is the round tripping and the overseas direct investment. So round tripping was something which is basically not defined, but it's a concept that has evolved over many years. And until August 2022, this was prohibited. With the amendments, there has been certain liberalization. So what is the round tripping? Round tripping is nothing but when an resident investor invests in a company outside India, a foreign company then brings back the investment into an Indian company. So there is a ODI leg as well as an FDI leg to such transactions. So these transactions were earlier prohibited, but now it is permitted. So permitted only up to two levels. So if there is a investment which is being made in a company outside India, that the whole subsidiary or that entity can further invest two layers down into India directly or indirectly. Okay, so and here there is a catch to it, that such investments of round tripping is permitted only if the Indian entity party who's investing is a body corporate or a company and not a resident individual. Now, resident individual can invest into a foreign company, but that foreign company cannot have any step down subsidiaries. So it cannot have a step down subsidiary either in a foreign country or bring back the funds into India. So these are certain critical aspects which generally come into play when you are structuring an investment in India. Okay. We discussed about the various compliances. Here is a brief checklist kind of one pager to talk about the compliances that need to be complied for inbound investments. Repatriation investments have to be either through normal banking channels or NRI account. Allotment of shares to be completed within 60 days of funds receipt, and then pricing guidelines have to be adhered to. RBI reporting by investee company and filing with the MCA within 30 days is mandated. Share certificates to be issued by investee company within 60 days after payment of adequate stamp duty. Here now, effective October 1st, the Indian government has made it mandatory for all investments to be in electronic form. So going forward, if anybody wants to invest in India, they should have a demat account in India, and they can only invest through the demat account. Okay. Then NRI investment is in listed companies can be only through NRI account. Sale or acquisition of shares by way of transfer to be again at valuation. Pricing guidelines are applicable, and RBI reporting to be completed within 60 days of the transfer of such shares. For the overseas investments, Overseas investments more than 10% in the paid-up capital is qualified as ODI. Investments less than 10% is classified as OPI. ODI reporting to be undertaken at any time of investment by the Indian party for any disinvestment and restructuring within prescribed timelines. These reportings have to be compulsorily made to the AD bank. Like I mentioned, resident individuals can invest only up to the LRS limit. That includes all your other expenditures as well, like your foreign travel, any other foreign currency expenditure. A person undertaking ODI shall submit an evidence of receiving the shares with your bank within 60 days, within 6 months of such investment. And then again, exit or transfer of any investment made outside India is subject to pricing guidelines. And any person, any entity who is making an investment outside India is required to file certain forms annually and submit necessary and where it is OPI, then a half yearly declaration has to be submitted by the entity in India. So this is the last and the third category of investments, which I thought it is, which we have captured. This is basically investments in startup in companies. The startup companies, again, you can invest in the equity instruments like any equity shares, compulsory convertible preference shares, or compulsory convertible debentures. Now, you can also invest in the form of convertible notes. That is, this is a type of investment that allows investors to convert their investment into equity at a later date. When when there's this particular condition that gets satisfied. Again, there's a condition that is such in convertible notes can be issued only if the startup and company has been registered as a startup under the Government of India, and investment in a convertible note cannot exceed 25 lakhs in a single tranche. Okay. Both. So the other convertible, the guidelines, which is generally applicable to FDI policy, also gets applicable to startups, most of the guidelines. Apart from the direct investment, ECB is permitted in other companies. That is the loan investment, not shares or investments. It is a loan that can be given to startups as well, with a different kind of guidelines that are applicable to startups. With this, I finish my presentation and then I move on. I think Rajesh will take it forward.
Yeah, I'm just kidding.
Thank you, Vinita. Right. So far, we have seen how the Indian economy performed, the stock markets performed, and how a person can enter into India and what are the regulations that to be taken care. Now, we will be looking for how the income tax is done. Okay, how the Indian income tax views these investments, how they are categorized, how they are taxed, and what all the procedures that one has to take care when exiting an investment. So to start with, before giving the presentation, I would like to make one point. These regulations, what we are going to discuss about the implication under the income tax law is the law pertains as of today. Reason being, on July 23rd, we had that budget of 2024, the second budget of the present government. There was many amendments were brought in, how the investments were classified, the rates applicable. So please take care. The law stands as of today is being discussed. So to start with now, see, when an inbound investment comes in, or in general, for tax law purpose, equity shares or even mutual funds are categorized into 2 or 3 categories, because these are the main stream through which the inbound investment comes in. Shares, first basket goes to listed equity shares. They have a separate treatment. And when we say listed equity shares, it means listed on a recognized stock exchange in India. And all other shares or securities will be classified as unlisted, irrespective whether they may be listed in any foreign stock exchange. So these are the two classification based on shares. And once it comes to mutual fund, we have three classifications. One, it's equity oriented mutual funds. Second, specified mutual funds. And the third one is the residual category. What all are equity mutual funds? Mutual funds that are obliged to invest at least 65% of their investments in equity or equity oriented units of any listed shares. Now, specified mutual funds. Specified mutual funds, the definition as of today it stands. They are the mutual funds who don't invest or to the maximum of 35% in equity shares. Please note, this particular definition of specified mutual funds have been changed in the budget, but it's not applicable today. It is applicable from the beginning of the next financial year, wherein it has been aligned or it has been brought in synonymous with the equity oriented funds, where it says equity oriented funds minimum 65% in equity. So specified mutual funds from next year onwards, it's going to be minimum 65% of investments in debt units, debentures or money market units like that. And any mutual funds which do not come in within these two categories will be classified as other mutual funds, maybe ETF, gilt edge funds like that. Now, for purpose of income tax, investments are treated as capital assets and shares or mutual funds are capital items. So in this category, any transaction in shares and mutual funds will be classified as transaction capital assets and will be taxed accordingly. Now, for the purpose of income tax, all capital assets are categorized into two categories. One is long-term assets, the other one is short-term. The general definition is that any asset which is held for more than 24 months is a long-term asset. If you hold any asset for less than 24 months, it's a short-term asset. There are few exceptions to that, and one of them is listed equity shares or equity-oriented units, zero coupon bonds like that, wherein the period of holding is reduced to 12 months. So in case of an equity shares, if you hold the shares for more than 12 months, it will be treated as a long-term capital asset. Now, you have long listed shares, unlisted shares, but the third category, that's specified mutual funds. These specified mutual funds, or in other way, debt mutual funds, you can call it. Irrespective of the holding period that you have, these mutual funds are exceptional and will not be classified into short-term or long-term and always treated as short-term. Now, why this long-term and short-term are being categorized? The tax treatment of the same are different. For example, in case of listed shares or equity-oriented units of a mutual funds, the long-term holdings for more than 12-month holding, they are treated as long-term capital gain and taxed at 12.5%, with an exception of long-term capital gain up to 125,000 INR. Please note, this is 12.5% post the budget. Earlier, it was 10%. And in case of listed shares, if it's a short-term holding that is less than 12 months, there is a fixed rate applies is 20%. And there is no base exemption limit available. In case of other shares or other mutual funds, 24 months as we said. So in case of long-term capital gain, you have again the rate is 12.5. But the only difference in comparison with the listed share is that you have a base exemption of 125K is not available for unlisted shares. And if the unlisted holding is less than 24 months, then slab rates applies. Slab rate in the sense, for example, for individuals, the taxable income is based on various slab rates. So based on this particular short-term income as well as the other income that is earned in India, when they aggregated, so the rate that applies to you for a particular person may be different. It may be 0, it may be 5%, 15, 20, or 30. So in the slab in which these incomes are categorized, accordingly, the tax rate applies. So there is no specific rates for the same. Specified mutual funds, since they are always treated as short term, again, the rates applies are slab rates. Now, to give you an example on this, assuming a non-resident buys a listed shares or unlisted share on, say, for example, June 1st, 2022. That is 2 years before now. And he sells it now in this month, say September 2024. He holds it for more than 24 months. In both the cases, in case of listed equity as well as unlisted equity, if it's for 24 months or more than 24 months, both are treated as listed long-term capital gain. Now, for a listed equity shares, you will take the sale value. That is, for example, in this example, we have given it's treated as 1 million as a sale consideration. Purchase price is $500,000. And we also assume there is a expenses associated with the transfer. That is the sale transaction. So first we will take it the sale price. Then we will reduce the associated expenses. In this case, for example, the brokerage, or it can be in taxes. That is assumed to be 10,000. So net consideration is 990K, out of which the purchase price, what in taxation terms we call it as cost of acquisition, is reduced. The balance is treated as taxable capital gain. And in this example, it is long-term capital gain. And now, since for listed shares, we have a base exemption limit of 125,000. That will be reduced, and the balance alone will be treated as taxable capital gain. But for unlisted shares, this 125K base exemption is not available. So the entire 490K will be treated as taxable capital gain, and the rates will be 12.5%, irrespective of whether it is listed or unlisted shares. Moving forward, this is a general overview what we have seen so far. For example, now coming to specific exemption or the treatment. In case of NRIs or person of Indian origin, we have a separate chapter wherein a special treatment is given. But this is not available for all types of investments or investments in shares and securities. There is called a separate segment of assets called specified assets. For example, shares in Indian companies, debentures or deposits in a public company, and any other investments which are specified or prescribed by the central government. So if you are going to invest in these specified assets through foreign exchange, that is, you buy it through foreign exchange, then these assets qualify for this special treatment. Please note, this chapter, it's only optional, and it's the assessee or the taxpayer or the investor has to choose it. Now, the capital gain will be computed in the same manner as what is applicable to the others. Now, what is the benefit there? Now, here what happens is, if you sell the shares and gets capital gain, you have a further investment option to negate the capital gain or to defer the capital gain instance. But the only point is that the proportion, the capital gain is exempted in proportion to the investment to the total net consideration that you are going to earn. For example, if your consideration is 10 million, to get whatever is the capital, 100% capital gain exempted, you have to invest 10 million. And further condition is that the new investment, you should hold it for 3 years minimum. If you don't hold it or you transfer it before 3 years, the exemption that they gave will be revoked and it will be taxed in that particular year. Now, this chapter, as I told you, it's an option. Assuming when you buy the shares, you were an NRI or a person of Indian origin, and subsequently you moved to India and you became a resident. But you can still choose to that this particular benefit will available to me for this particular investment I made in foreign currency when I was a non-resident. The only point is that when the shares are sold in the return of that particular year, this particular declaration has to be given to the tax office. Now, as this is an example, synonymous with whatever we have seen, assuming the 1 million is the selling price, 500,000 is the purchase price, and you have a 10K brokerage. In this particular case, what will happen is the 490K, the capital gain will be there. And further, we will assume we are making an investment of 50% of this consideration, that is 500,000. Even if in this particular example, though the investment is more than the capital gain, still you will get only part of the capital gain exemption, because the main reason is the exemption is based on the ratio between investment and the sale consideration. Here, the sale consideration that I received is 990K. The investment I made is only 500K. So in proportionate to this, my capital gain will be treated exempt. So in this present case, 247,745 will be treated as exempt, and the balance will be treated as taxable capital gain, and it will be taxed at 12.5%. Now, moving further, we have seen what are the categories, how the tax computation is done. Now, there can be three types of transaction in any investment for tax purpose. One is the income that you receive. It can be dividend income or interest income. Or when you exit, it can be capital gain. It can be long term or short term. Now, how to treat when you exit? The main point that one has to take care is that all transactions with a non-resident in India are subject to withholding tax implication. The law says any person who transact with any non-resident, all transaction without an exemption has to be checked for withholding tax compliances. When it comes to income, say for example, dividend or interest, the general rate applies for withholding is 20%. But further, that can be reduced to 10% if you avail the double taxation avoidance agreement benefit. That part will be taken by my colleague later in stage, but we will just touch upon this one, that's all. For example, in case of long-term capital gain or short-term capital gain, the law provides is that withholding applies on the sale consideration and not on the capital gain. Please note, generally, for example, long-term capital gains are taxed at 12.5% on the gain. But when it comes to withholding tax, it happens that 12.5% withheld on the sale consideration that is being paid by the resident to the non-resident. So now, how to overcome this? Because 12.5% on the capital gain is always lesser than 12.5% on the sale consideration received. This will block substantial amount of capital. So to negate this, there is an option available under the income tax law wherein it says before you effect the transfer, make an application to the tax office, work out the taxes on the capital gain and arrive at the rate of that particular taxes on the sale consideration, then apply for that particular rate to the tax office. The tax office will conduct a pre-audit of this application, and if they satisfied with the application, they will issue for a lower deduction certificate. Based on that, the resident who is going to buy the shares, or it can be even a non-resident to non-resident share sale, if the buyer can deduct taxes at a reduced rate, whereby the taxes on the capital gain each matches when it ultimately applied by the buyer. This one, it will save the blockade of capital. Second, it will help the seller to get his return at the earliest possible. Otherwise, you will have to file a refund application with the tax office. That is after the end of the tax year. So the time that your capital blocked out will be near about a year. Now, moving forward, the another exit compliances or every year in case of income earned, you need to analyze the consequences of tax return filing. When it comes to the regular transaction, say for example, dividend or interest, we have a separate section which provides that if the income are subject to that particular section rate, that is 20%, and taxes are withheld in accordance to that particular section, then no income tax return needs to be filed by the investor or the non-resident in India. But if the taxes are not withheld according to that particular provision or by following any other provision, then this particular benefit is not available. Similar to that, when it comes to capital gain, as we saw the chapter which gives the beneficial tax treatment for PIOs and NRIs, it also contains one more benefit, that is, in case the taxes have been in the year in which the investment is sold and the taxes have been deducted by the buyer in accordance to that particular chapter, then also the seller need not file his tax return in India. Please note that this is applicable only when that particular transaction is there. Assuming that you have multiple transactions and these transactions only one of them, then this particular exemption may not be available because you may be subject to file tax return for the reason of the other incomes, that other income that you may have. You may have a property income in India, you might earn other incomes from out of that. So these are the exit compliances that you will have to take care. So when it comes to exit compliances, please make sure LDC is applied in well before the transaction being effected. Once the transaction being effected, there is no approval is given for a lesser deduction. These are some of the points that I would wanted to make. And now I will give out the baton to Indra so that he can enlighten us upon the taxation of Indonesia. Over to you, Indra. Thank you.
Pandra, you can take the control, please. Yeah, Patroni.
Thank you, Logan. Yeah. Hi, everyone. Indonesia is an attractive country for investment. In 2024, the countries with the most investment in Indonesia are Singapore, China, Hong Kong, South Korea, and the United States. The most investment sector are the mining and basic metal industry sector like nickel, steel, and iron. We know one thing that influences investment decision is tax. We try to expand in general about the tax treatment in Indonesia. My staff, Tony, will help me to present it. Yeah, please, Tony.
Okay, thank you, Pak. Okay, I will share my screen first. Okay, so can everyone see my screen, my slide for the tax issues in Indonesia? Okay, Pak, can I begin?
Yeah, silakan.
Yeah, thank you, Pak. Yeah, first of all, I would like to share some insights on the tax issues in Indonesia in relation to tax residents and non-residents. So the most recent regulation concerning taxes in general is Law Number 7 of 2021. It is regarding harmonization of tax regulation. It's a breakthrough regulation, breakthrough law from the current Jokowi administration. So in this particular law, the tax resident, whether they are individuals or entities, are obligated to pay taxes on the income obtained or earned within or outside the Indonesian territory during any fiscal year. And in general, the income tax in Indonesia is classified into two categories, namely the corporate income tax and individual income tax. Okay, so next up is concerning the status of residence status in Indonesia. First is about the corporate residency status. So a company or an entity is considered resident in Indonesia for tax purposes. It meets one of the following criteria, namely it is incorporated or established in Indonesia, or it has its management or head office or headquarters in Indonesia. And then the resident corporations are subject to tax on their income earned worldwide. And then if a company is not established in Indonesia, but it earns income from Indonesian sources, it is only taxed on Indonesian source income, typically through withholding taxes on certain transactions, such as dividends, interest, and royalties. And next up is the tax rate for corporate income tax. The corporate income tax, or CIT, is imposed on the income of the resident company, and the standard rate is 22%, the current applicable rate. However, there are several concessions or discounts given to businesses with regard to the CIT if they fulfill the following condition. First is companies that are publicly listed which offer a minimum of 40% of the total share capital to the public, or also known as free float. They are subject to a 3% tax cut from the standard rate. So
Tony, Mafia, your slide is not moving. It's still in the first slide only.
Oh, sorry, Pak. I already moved to the third slide. Can you see the third slide already in the corporate income tax rate?
No, it's not moving. Can you just unshare and reshare it, please?
Yeah, I will stop sharing and using your slides instead.
Can I share, Patoni, if you are okay? Is it possible? Can share, huh? Okay, just give me, yeah, thanks.
So we already reached the third slide.
Okay, again?
Should I repeat from the first slide or just move on?
No, from third. Yeah, this is fine. This is okay, again? Yeah,
thank you.
Okay. Yeah.
Okay, thank you, everyone. So I already explained about one of the companies, the conditions that can receive tax discount for the regular tax rate. First is the publicly listed companies, which can receive 3% tax cut. And then the second category is companies that with an annual turnover of less than 50 billion rupiah or equal to around 3.5 million USD. They are eligible for a 50% reduction from the standard rate for the income of up to 4.8 billion rupiah, or around 336,000 USD. And also the third category is companies with a gross turnover of less than 4.8 billion rupiah, of no more than 4.8 billion rupiah. They are subject to a final rate of 0.5% on the total turnover. Okay, next slide, thank you. And we'll also explain about the individual resident status. So an individual is considered a resident, an Indonesian resident for tax purpose, if they meet one of the following conditions. The person is domiciled in Indonesia. He or she has a permanent place of residence in Indonesia. And the second condition is, or the second condition is, the person is physically present in Indonesia for more than 183 days within any 12-month period, meaning for a fiscal year. Or the person is present in Indonesia during a fiscal year and intends to stay by obtaining a work or stay permit from the immigration authority. So even an individual doesn't meet these conditions, they are considered a non-resident and only taxed on the Indonesian source income. And also Indonesian residents are subject to tax. A resident of Indonesia who is a tax resident here, they are subject to tax on the income earned worldwide. So they must report and pay taxes on both the income earned in Indonesia and overseas. Also, individuals are taxed. The tax rate applicable to these individuals or between 5 to 30%, depending on the income threshold. So there are certain categories from the taxable, non-taxable income and other segments. Okay, but thank you. So Indonesian tax residents are generally taxed on a worldwide income basis. However, there are certain offshore income which can be exempted from income tax if it is reinvested or used for business activities in Indonesia in a certain period. The first is income received by an Indonesian taxpayer from a permanent establishment abroad, or dividends paid by companies abroad, and active business income received by an Indonesian taxpayer from abroad, not from a permanent establishment or foreign subsidiary. And for after-tax income from the permanent establishment and dividends paid from the non-state subsidiary, the minimum reinvestment amount is 30% of the profit after tax. Otherwise, the difference between the 30% threshold and the reinvested portion will be subject to income tax in the form of government-approved shares and bonds. So I believe. Last slide, I will explain about the deemed dividend. So certain income of controlled foreign companies are subject to deemed dividend rules in Indonesia on dividends not yet distributed. The income includes dividends, interest, rentals, royalties, and gains from sales or transfer of assets. And the definition of CFC is a foreign entity that is at least owned by 50% by an Indonesian taxpayer, individually or collectively. The ownership threshold that is used to determine the CFC status is the ownership percentage at the end of the Indonesian taxpayer's fiscal year, which is based on either the paid up capital or paid up capital with voting rights. So the only exception to this rule is when the CFC share are listed on a stock exchange. So this is a little insight that we can share with regard to tax residence status in Indonesia. So I will turn to Pak Indra and Pak Logan. Thank you, Pak.
Yeah, thank you so much, Pak Tony.
Thank you.
Yeah. Pak Indra, you have any comments to, or we can take the questions towards the end of the presentation, Pak Indra?
Yeah, maybe we can see the question. How to avoid paying in Indonesia about the equity, capital gain. Okay.
Yeah.
So maybe you can see in the rule, in our rule, the tax on we can give example for the interest. Yeah. The tax on interest will be imposed when it is due. So it means if you choose the long-term investment, so you don't need to pay tax in the current year. So you can avoid in the next year or until it is due. Yeah. But if you choose the short-term investment, so it means you have to pay the tax now or next year or others. So it means if you choose the long-term investment, it will be avoid the tax in Indonesia for the interest. Yeah. And for the share, maybe for the dividend, the tax on dividend will be imposed when it is declared. It means declared means the share of the dividend as allocated to anybody of the shareholder. So it means you cannot avoid when the company has declared the dividends. So it means it will be taxable. Yeah.
Okay, thank you, Pak. Thank you, Pak Indra.
Yeah.
Now, okay, over to you, Ashish.
Yeah, so with the basic understanding that we have now on the rules and regulations to invest in India, then how is that going to be taxed in India? And then how is it going to be taxed in Indonesia? Now, what generally happens, the global rules of taxation is basically there are two major rules of taxation, or the country is generally taxed based on two major rules. One is the source rule and one is the residence rule. Now, considering the current discussion that we are having, there is a source emanating from India, that there are capital gains, there are dividends, might be interest income that is sourced out of India. And this is being received by a resident of Indonesia. Now, what happens is India taxes it based on the source rule. Indonesia taxes it based on the residence rule, considering the recipient is a resident of Indonesia. Now, this obviously leads to double taxation, and we've also seen a question that has been answered by Bakinder, that there is a situation of double taxation where India withholds taxes when this money is being remitted out of India, and then we have Indonesia taxing it based on residence. To avoid this, majority of the countries across the globe have entered into something called as double taxation avoidance agreements. Basically, these are the tax treaties that have been discussed and arrived at by multiple countries to avoid double taxation, to eliminate double taxation rather, and currently it is known as covered tax agreement, which has been amended after the introduction of multilateral instruments. Now, with specific to India-Indonesia tax treaty, there are a couple of articles that are important for us to consider today. That one is Article 13, which talks about the capital gains. Now, capital gains, as per the tax treaty, it has given the right to both the countries to tax it as per the local laws. So, assuming there's a capital gains that is being sourced in India, that has been accrued in India, the Indian tax authorities can tax it as per the local laws, withhold taxes as per the local laws, and then the Indonesia as well can tax it as per their local laws. How we can avoid double taxation or how we can claim a credit, we'll probably see later. Then there's something on dividend. Now, so with respect to dividend, there's a deviation with respect to capital gains. Now, with respect to dividends, when there is an Indian company paying out dividends to an Indonesian resident, there is a beneficial tax rate of 10%. Basically, the India tax authorities can only withhold up to 10%. However, the local law, the Indian Income Tax Act, has prescribed a few documents that is mandated to be given if you wish to avail the beneficial rate of 10% of the tax treaty. What are those documents? One is the tax residency certificate, that it proves that the recipient of income is a tax resident of Indonesia and eligible to claim the benefits of DTAA. So a TRC needs to be provided by them to the Indian tax authorities. A declaration of no permanent establishment or a business connection in India, that will help to rule out any possibility of business income. Then there's another form, local form, that needs to be filed on the Indian Income Tax portal by the name Form 10F. Now, all these three documents put together will help in availing the beneficial rate of 10%. Then, as this results in double taxation, let's move on to the concept of something known as foreign tax credit, which helps in eliminating double taxation. So, what happens in the FTC is that the taxes that are paid in India based on the source rule can be claimed as a credit in Indonesia based depending on the following formula. I mean, there are three amounts that we're talking about. There's an amount calculated based on FTC rules, that is the average rate of tax that is generally payable in Indonesia on this foreign sourced income, and what is the actual foreign tax paid in India, and what are the tax as per provisions of DTA. The lower of any of these amounts is generally allowable in FTC. We'll quickly run through a couple of illustrations to help us understand better how FTC works. So let us consider this example where the total income for an Indonesian tax resident is, say, 20 million USD for a year. Out of this, the income earned from India is around 10 million USD. We've assumed a flat tax rate of 20% in Indonesia. So therefore, on total income, the tax payable in Indonesia is around 4 million USD. Now, assuming in scenario 1, we're talking about an income which is earned in India is only taxable in any one of the countries. There are certain treaties which do allows exemption rule where basically only one of the countries allowed to tax it. In such a case, when we're talking about, then the provisions of FTC are not applicable. Only one of the country will tax it. But in our case, where we're talking about dividends or we're talking about capital gains, we'll move to scenario 2 where we specifically cover it. In scenario 2, let's take case 1 where we are talking about capital gains, a long-term capital gains of 10 million USD that is earned in India by an Indonesian tax resident. Now, as discussed earlier by my colleague, the tax in India is at a rate of 12.5 plus surcharge plus cess. On an income of 10 million USD, we have to pay at a tax rate of 14.9%, which approximately amounts to 1.5 million USD. This will work by as a withholding in India. And on the same amount, as we discussed, the assumed tax rate is 20%. In Indonesia, we'll have to pay 20%, around 2 million USD. Now, there is 1.5 million USD paid in India. I have to pay 2 million USD in Indonesia. And even as per the tax, as per the DTAA, we are allowed as per the local law, which is 1.5 million USD. So the lower of these, all three amounts we're talking about is 1.5 million USD. So while before we have to pay 2 million USD in Indonesia, we can claim a credit of 1.5 million USD and probably only $500,000 USD will have to pay in India. Now, this is how the FTC works, which allows us to claim a credit of any foreign tax paid abroad on foreign sourced income while we are paying our taxes in our home country. We'll take another example just for better understanding. Assuming that we have dividend income sourcing out of India, which is around again 10 million USD. Now, as we spoke about, to claim the benefit tax rates of DTAA, we have to give this document. Assuming if those documents are not provided, you do not provide any one of the document. If you do not provide a TRC or you do not provide an OP declaration, you're probably not eligible for a beneficial tax rate. Then the highest tax slab rate, especially for an individual, will be applicable. We're talking about 30% plus surcharge plus cess. So tax in India will be around 35.8%, which is around $3.6 million that will be payable in India. Tax payable in Indonesia is 2 million, as we discussed earlier. Now here, this is the point which is worth noting. The tax as per DTAA is 10%. Basically, Indian government and the Indonesian government have agreed that the tax payable on dividend is only 10%. Now, due to the local law on non-production of certain documents that we've seen, the tax paid in India is at a higher rate of 3.6 when compared to 2 million USD in Indonesia. Now, by itself, that will not allow you to knock off completely 3.6 or to the extent of $2 million into Indonesia, because the tax rate as per DTAA is $1 million on 10% is only $1 million. So we'll be allowed an FTC of only $1 million, and the balance $1 million has to be paid in Indonesia while filing the returns in Indonesia. So with this, we've understood how generally FTC works and how the provision of documents also plays an important role to avail maximum FTC. And coming to the end of this session, I would like to sum it up with this key points that we can take home today, covering the majority of statutes in India that impacts in such transactions. So to begin with, there are categorization of target investments under the prohibited route or the restrictive route or the automatic route. When we're talking about FDI, what is the mode of investment? What are the bank accounts? What are the resultant repatriation implications that we need to take care and accordingly decide on the mode of investments? What is the plan? How to plan the flow of investments, especially considering the ODI and the round tripping rules that to ensure that there's no non-compliance. Again, a very important factor, especially when we're talking about unlisted shares, is the fair market value that we need to adhere to the pricing guidelines and the related FEMA compliance with regard to the due dates and the forms that needs to be filed within the time period provided by the law. Then what is the tax impact on sale or transfer of the securities in India? Especially for NRIs and PIOs, what are the reinvesting options to claim beneficial deductions or at least to defer taxation? What is the overall income tax compliance when it comes to return filing, tax deduction at shows, lower deduction certificate, provision of documents for claiming tax treaties? How does Indonesia taxes this income in the home country as a resident? And eventually, once India and Indonesia both have their individual taxation, how can we invoke the provisions of DTAA and claim FTC in such cases and ensure that we do not pay taxes twice on the same income? With this, we end this session and I hand it over to Mr. Loganathan to take up the Q&As.
Thank you so much, Ashish, and thank you so much, everyone, speaker. So now let's open the form for the Q&A session. So from the audience, if you have any Q&A to be asked, we can raise the hands and we can allow the mic and camera. So Mahendra, just give me a minute. Yes, Mahendra. Now you can unmute and you can talk. Hello, Mahendraji. You can unmute yourself. I gave the control. I just allowed it. You can try now.
Hello.
Yep. Yes, you are right.
Am I audible?
Yes, very much. Yes.
Yeah. First of all, I would like to sincerely thanks to the Rockstar for arranging this very useful session. I would like to first understand that this Rockstar is a tax service provider company in Indonesia.
No, this is just it's a friends group. It's a community of Indians. It's an informal group we have in Indonesia to help each other. The social community.
Understand. So, Pa Gunawan, I am working in Indonesia just last from 11 months. And I have many complicated cases actually with personally and as well as my company also.
Okay.
So I just want to brief a little bit. See, I am working last 13 years outside the country. Last 12 years I worked in Thailand and I have some income and investment itself is still there in Thailand. And now my income in Indonesia that I am sending to India, mostly I am keeping in fixed deposit, bank fixed deposits. And my elder son, he is studying in UK. Just now he went to UK for study. And I am transferring some school fee from Indonesia to UK directly. So I have some questions on all these complications that I am sending in my income from Indonesia or earlier income from Thailand to India in FD, fixed deposit banks, sending money to UK for my son education directly from Indonesia. How it will be treated in India tax calculations and as well as in Indonesia tax calculation. One thing that many of the colleagues in my company are receiving the letter from Indonesia Tax Department to submit some taxes on income in India. See, I am working in Aditya Birla Group. I am working in PT Indo-Bharat Rayon, Indonesia in Purwakarta.
Yeah.
Yeah, Pagunawan, you must be knowing.
Yeah.
So there
And
are,
I know.
there are 5-6 companies in Aditya Birla Group in Indonesia. And
Yeah.
mostly Indian experts are getting this letter from the Indonesia tax department, and few of them had to deposit the tax here without any reason. They are not known how to avoid this income, how to avoid this tax. So these are the questions from my personal income tax purpose, as well as this PT Indo-Bharat Rayon company is a very big company itself, having the revenue and on standalone basis $400 million, and also holding company with the 4 big subsidiaries, and on consolidated basis the total revenue is $10 billion. The subsidiaries are in Singapore. And just last 2-3 days, I was reviewing the corporate income tax working of my company. I came to know about the CFC and dividend income, deemed dividend income, just in last 2 days, and today I'm listening all this here. So I was just thinking to engage some tax consultant for taking care of PT Indo-Bharat Rayon, as it is a big holding company.
Yeah, Mahendraji, I just wanted to give you a few inputs and background about me. I used to work for Indorama and I lived in Purwakarta, and this is my 17th or 18th year in Indonesia. So we specialize in Indian, Indonesian, Japan taxation. So I used to liaise with Dharmendraji. I think he left recently.
Dharmesh.
Dharmesh ji, yeah, Dharmesh ji.
Yeah.
So I used to come there and have some kind of this thing. Can we take this offline, Mahendra ji? You have my
Sure.
contact details, and
Sure.
I'm happy to meet up, and probably we can take it forward. You have my number and connection also.
Can you drop your number here, please?
Yeah, I will do that. I will send a separate mail also.
Thanks so much.
Yeah.
Then connect, and I have a lot of things to work on this.
Yeah, yeah. I mean, because let's keep it in a private meeting so that we can spare the others.
Sure,
Yeah.
sure.
Thank you, Mahendraji.
Thank you so much.
Yeah. Any other questions we can take? Mr. Varun is here. Mr. Ravi. Govil. I'll just allow mic to Mr. Ravi. It just came in front. Yes, Ravi ji, go ahead.
Am I audible?
Yeah, very much audible. Yes.
Thank you, Mr. Logan and team Rockstar team. I have a question like just now the other gentleman mentioned. Lots of Indians are getting this tax notice from Indonesia government. So, can you just, if you have idea, brief like what is the criteria, what is the basis of these notices and how they calculate the income in India?
Notices, I mean, it's specific to it individuals, but we can get to know from Pa Indra. Pa Indra, can you explain us what is the you might be knowing and had some of the our experts communities notices. Can you just quickly help Pa Ravi and others on what basis we are getting the notices and how to resolve it quickly? Pa Indra.
Okay. Yeah, thank you, Palukan. That we know, the Indonesia has used the worldwide income basis. So it means every income that you got from abroad or from Indonesia has to report it in the tax return, But, for the individual, we will count the tax if it's realized. It means if someone has give a question about the accrued income, so it means if I just accrued, there is no tax for that. So for individual, only if you got the income, real income, and not accrued, because individual doesn't have bookkeeping. So it means if you want to count your tax, you just count if you got the income, real income. Okay, that's all.
Yeah, Raviji, I hope you get answered. If there is any specific on the notices, which see the notices usually comes around this only. Your total income is this much because we have a information sharing signed between both the countries. The whatever the data we are having in Indian income tax department is automatically transferred to the Kantor Pajak at DJP online Indonesia. So by which means both the countries knows where we are getting income and what is the total income which are taxed or not taxed. Because by AAS last year, I mean, this year we introduced in India AAS annual information system, which is much comprehensive than 26 AAS. With that, you will be able to know anyone can be, downloading the AAS can be knowing that where all the our investments, what is the actual revenue which we are generating, income generating, whether we have paid TDS or not, that has to be included in the Indonesian total income statement. The moment you become a tax resident in Indonesia, and you got to declare, I mean, not necessarily pay taxes, but at least declare both the incomes are global income and take credit of whatever the tax paid already or TDS paid in India or withholding tax paid in anywhere in the world. That much is available very much. The only thing is most of us are ignoring the provisions or laws available for our benefit. Okay, so let me give Pa Sumesh.
Thank you, Pa.
Yeah, thank you. Pa Sumesh ji, I'm just giving you mic and camera.
Yeah.
Can you hear? Thank you.
Yeah. Am I audible?
Yeah, very much.
Yeah. Thank you, Mr. Anandan. My question is that I am NRI for last 12, 13 years. So now I am planning to move to India. So my most of income in India is on the FDs and interest. So for all these years, because I was reinvesting the interest again in the FDs, so there was no income tax paid in India for last say 12, 13 years. But now, if I am going to India and this NRI account will be converted to a normal account, how that income, those FDs will be treated?
Rajesh, I think it's your area.
Yeah, I'll take care. See, the NRE income, the incomes that comes from whether it's a savings bank account or it's an FD, it is completely exempt from tax in India until you are a non-resident. The moment you become a resident in India, then these NRE deposits are taxed at par with your other normal fixed deposits. So long you are a non-resident, these are NRE deposits income are tax exempt. So you might be seeing that NRO account, if any income comes in, the banks will automatically deduct 30%. The maximum rate applies to individual, the 30% TDS on your income and would have been paid to the government. But NRE, such provision would not have been there. You can take the statement. But the moment you become a resident in India, once you come back after your assignment, then these NRE deposits will not get the preferential treatment and the income accruing from the NRE account will be taxed in India.
So in that case, is it advisable to break all the FDs and take the interest now while I'm still, say, non-resident?
See, breaking the deposits is an option, but you will lose the interest.
Yeah, but I think that is like because these FDs are over a period of say 12, 13 years.
Agreed.
So yeah.
But my question is, see, till the time you become a resident, you can keep there.
Okay.
So if you are going to come back to India, say maybe after 2 years, keep it for another 2 years. And once you break the FD, what you're going to do with the capital, that determines everything.
Okay. And once if I break all the FDs and it is part of my NRA account, so at least that till that time it will be non-taxable. Then after say if I am moving to India say in December or January, from that date it will become taxable. Is it like that or how is it?
No, the year in which you become a resident.
Yeah.
So we go by similar to the Indonesian tax resident status. We have also certain conditions saying like that you have to be in India for more than 182 days or some other criteria where it says 120 days coupled with the 15 lakhs of India accrued income. So we have various criteria. So the year in which you become a resident, from that year, your NRI deposits will get taxed. Not the deposits, sorry, the income accruing on the deposits.
On the deposits. So if because in all these years, say all the interest was accrued in the FDs, so all those interest will become in 1 year.
No, not that way. From the year in which you become a resident. So long the 12 years, whatever your income that you earned is tax exempt.
Okay. Thank you.
Thank you, Merci. And I disabled Varun G's mic. So Mr. Varun, you can. Hello.
Can you hear me?
Yes, very much. Yes.
All right. I just have two questions. One, which is when we invest outside, we are creating assets. So from an asset perspective, when we sign up our forms and we give to the Indonesian tax authorities, we just declare these assets, and what happens to these assets that have not been declared? Say, for example, this rule comes in 2021. We've created assets in 2019. How does that come about? That's question number one. The second part is working for international companies, we get stock options which vest over a period of time. How should those be declared, and what are some of the rules surrounding that? I don't know if it's Indra or Logan.
No, I think it should be Vinuta.
No, I think the question is on the Indonesian part, right?
Correct.
Yeah, he is not a resident in India, so
Yeah,
the
I'm a
so
resident in Indonesia for the
yeah,
last 18 years. I've created assets outside of the country as well as hold, FDs inside of India. The question really is, these have not formed part of declaration over a period of time. So how should I, and these were again based on post-taxed Indonesian income. So effectively, I should just be able to declare that. And if there are gains, then those gains are taxable. Is that understanding correct?
Correct. Yeah, that's correct. Yes, Rajesh, you have any input?
I will. Now, if my understanding of the question is correct, Varun has certain assets in India, outside India,
Correct.
including ESOPs, right? So
Yeah.
when it comes to Indian tax,
Yeah.
see, as far as you are a non-resident,
Mm-hmm.
you don't have to disclose any assets that is abroad.
To India. But what
Yes.
about my filing to Indonesia? Do I declare them?
Yes.
How
See,
does that work?
generally how it happens is the country in which you are a resident,
Yep.
in that country, you have to disclose not only the assets in that country,
Mm-hmm.
anywhere in the global, whatever assets you have to disclose that. So at any point of time, you will have to disclose all these holdings to one country. Now,
Understood.
presume as of now, since you are a resident in Indonesia,
Mm-hmm.
the declaration has to happen to Indonesia through the tax returns what you file, I assume.
Yeah.
Indraji can
Yeah.
confirm me that part.
Yeah. Yeah. The answer will be different if you are a resident of Singapore. Okay. So,
Yes, I know.
so yeah, question is same, but the same a different answer depending on the tax resident countries, because we do practice in Singapore also. The answer will be totally different than what we are giving to you right now. So yes.
So I think my question remains, which is, these assets were created pre-2021. So when do I declare them? Because I've not declared in the past, so I declare them now. Is that what is the expectation?
Yeah.
From this year going forward.
Yeah, the earliest date will be this fiscal, right, Pandra?
Yeah,
If
yeah.
this fiscal is the right time to disclose it, if not disclosed, or before receiving any notices, right, Pandra?
No,
You know,
I understand. Look, this is not an intent to hide, but this is an intent to be aware.
No, yeah. This is where in Indonesia, we got some 2 or 3 tax amnesties came in. A couple of years, we were here for quite some time, so you might be aware of it. So we got an option to, disclose all those things by way of a tax amnesty. So that's how the government expected us to disclose all those undisclosed assets, income, and all those things. So the earliest date is now, if not earlier.
So then you are saying that these will again come under the purview of non-declared assets and attract some tax, but these were again from post-tax income in Indonesia, and they haven't accrued any further gains or capital gains in any other country. So how would that work? Like, I'm a bit confused on this particular aspect. I don't have a problem declaring. I can potentially also dig up my records and prove that if funds were transferred outside of the country to buy the asset. So
Actually, this is what they wanted to even check or audit,
check, right,
and ensure it.
Indra, is there any risk if we disclose now, it's not been disclosed so many years? But anyway, Indra has been from DJP, so he can handle what.
Indonesia and India has a exchange of information system. Sometimes tax authority from India give us the data, and many person in India get the notice from DGT. Yeah, so it's mean there's a risk for that if the data come from the tax authority from India, so it's mean the DGT will be issue the tax notice for you. Yeah, so better you can declare, or you can make a revision of your SPT or tax return for 2021. Yeah.
Okay. Okay.
So you suggest to go for revision also, is it 2021 and 20? That will be better, is it, Pandra?
Yeah, 21,
Okay.
22.
Okay.
So Varunji, only to India those assets based in India, you disclose to India.
Which I think are already disclosed in India, because now starting last year I've started filing the ITR just to be kind of consistent.
Yeah, you should
with
be,
both.
because
Yes.
that will help you out to
Correct.
have a continuity when you come to India.
Yeah, understood. No, thank you so much for this. This helps.
Yeah, thank you. And Brajesh Singh ji, just I'm disabling. Okay, you can unmute and speak, Brajesh ji.
Hello.
Yeah, we can hear you.
So first of all, thank you so much for such an informative session. I have one question. I was reading some regulation, and if I have to read, it says foreign citizens may be taxed only for their Indonesian source income for first 4 years if they fulfill their certain requirements. So can you please elaborate? My question is, let's say somebody
Yeah,
who is less
so I
than
can
4 years of
understand. Yeah, there is a specified list of 44 or 45 professions. You need to fix into that particular designation while applying for KITAS. If that be the case, you are exempted for the first 4 years from the taxation of global income. If not, generally you will fall under normal residency status. Then you got to file and you got to be a tax resident of Indonesia even from the first year itself.
Okay.
So that goes hand in hand with the KITAS immigration application and your designation in the company, which is very, very specialized designations. 45 or 47, I'm not sure. So that list we have it. So only if you are fitting into that particular list, then you are exempted for the first 4 years.
Got that. So, thank you.
Yeah. Yeah. Next, Mr. Abhishek Mishra. I'm just. You can unmute and speak, please. Hello. Abhishek, Mr. Abhishek, you can unmute and speak. Yes, getting into some problem. Okay, I'm allowing mic to Mr. Manoj. Mr. Manoj, you can unmute and speak.
Yeah.
Yeah, thank you.
He muted.
Yeah, we can hear you.
No, I think he went out to mute again.
Acha, he went to mute again.
Can you hear me?
Yes, yes, very much, yes.
Okay. In continuation of the individual tax, but like now in my company also some Indians are getting the notice from the Indonesian tax authorities, and they say 2020 income tax filing, you're not declare your money assets in India. So the question is, the money transferred from here after paying the tax, correct? And it is kept in the NRI accounts. So NRI accounts don't earn any interest tax in India. So when we declare, suppose 2020, what was the assets? Number one, we very difficult to find out the total assets, means total, how many fixed deposits or total amount. Okay, that's one question from India. But I mean, if he declare assets, let's say Indian money 3 crore or 4 crore or 5 crore or whatever. So maybe 6, 7 million or whatever, 8 million. When he declares, how is the tax paid for that? Or because this is in an NRI account, so it will be any tax here?
No, keeping money in NRE account doesn't warrant you to pay any taxes because it's end of the day savings, right? I mean, no country has, it's a tax afford money you are saving in Indian bank account, but No country has the right to, tax 2 times for the same tax suffered income. That's a general rule.
But in India, this NRI account interest are tax-free.
Yes, correct.
So when he declare here in Indonesia total assets, how the tax? Will any tax need to pay to Indonesian government or what? And how?
Acha, this is the question. Yes, then yes. Interest income, which is not taxable in India, but you got to declare in Indonesia, then that will be charged under other income, right? Yes, Rajesh? Yeah.
Yes. See,
Yes.
NRI deposit, you don't pay any interest in India. So when you are a resident in Indonesia, you will disclose the same interest here. Since you are not paid any taxes in India, whatever the tax levied by the Indonesian government, you will have to pay it in Indonesia.
Oh, okay. Okay. Thank you.
Yeah. And Mr. Anjan. Mr. Anjan, you can unmute and talk. Hello. I think it's not. Okay, Mr. Surya, I just disabled the mic. You can unmute and talk, please. Hello.
Good day to everyone. Can you hear me?
Yes, very much. Yes, Pasuri.
Okay. Thank you very much for this wonderful presentation. We have some idea about the taxation now. Okay, so there are a few questions for me. So I'll start with the taxation. So I've been working outside India for the last 17 years. So my concern here is I've been investing in India in stocks and mutual fund based on the income I've earned outside India. But I regularly send money to India and I have been investing in stocks and mutual fund. Now my question is, if I've invested say around 4 crores in India and it has doubled today, because I've been investing for some time, so say has doubled to 8 crores, what will be if I realize it? I have not realized it yet. So if I realize it, what will be the taxation today, and what will be the taxation say after 1 year if I give up my NRI status? Will there be a difference in taxation if I'm an NRI and I realize it, and if I give up my NRI and I realize it?
No, basically there won't be much difference because of the residential status. The year in which you realize the gain, that year you will have to pay capital gain tax, irrespective
That's
whether you are a resident or a non-resident.
So it's the same 12.5% on the long-term capital gains.
12.5% applies. Now, having said that, if you are covered within the chapter 12, the beneficial provision that is applies to a NRI or PIO, then you may defer it by the capital gain incidents by further investing the same. But once you come back to India as a resident, then you may not be able to invest further in the specified asset by way of foreign currency. So at that time, you may not be able to take the benefit of deferring it by way of additional investment. Otherwise, the tax implication remains the same. There is no tax on accrual. As and when you realize it by way of selling it or transferring it or switching over to fund, then capital gain tax will apply.
Okay. The next question is also on the same lines. I have been investing on my wife's and 2 children equally. So say the same example, 4 crore.
So are they,
been investing
are they also non-residents?
That's what my question is. So I've been investing on their name, say 1 crore on each for the last 5 years. When I started the investment, they were actually not NRIs. They were in India. My wife was in India. She was giving delivery there, and so it all happened there. But eventually, after 2 years, they have also moved to Indonesia. Now they stay with me. So now I've been continuing the investment, and the holdings have been going on. And so what will be again the same question? What is the difference? If it's under my name or it's under their name, the source of income is all from my salary. So what would be the impact in terms of the taxation?
See, basically, you are gifted the amount to your spouse and children, right?
Yeah, correct.
And from there, it has gone. It's not. It's basically, if I speak from your bank account, it went to their bank account. From their bank account, it's got invested.
Correct.
Now, legally, even though they are the owners and the income has to be taxed in your spouse case, there are certain sections which clubs those incomes in your hand. Two instances: one, transfer of any asset to the spouse without consideration, transfer of any asset to minor son without any consideration. Any income arises out of these type of assets are to be clubbed along with the income of the person who has gifted it. For example, the mutual fund income on both your spouse and son will be clubbed with your income.
Okay. Okay. The last question is, I have not really got any income in India. I've only been investing, and there's some rental income, probably a lakh or less. So it's on a yearly basis, it's not anything sizable. So I've never filed my taxation. So is it something a concern, or is it okay to be that way? Because it's almost like 17 years out of India, but never file a tax.
No, it depends. See, when you say rental income, okay, irrespective of the amount, the criteria for filing tax returns are separate. Now, one of the condition is that if your gross income goes beyond 250K, then you are supposed to file tax return in India, irrespective of whether you have to pay taxes in India or not. Assuming your rental income earned is, say, 300,000, for example, for the entire year itself, then even though you may not have to pay taxes in India, you will have to file tax return in India.
Yeah, but it has never been more than 2.5 lakhs. It is always 1 or 1.2 lakhs.
Okay, so in that condition, you need not file tax return in India, but there are certain other conditions. Do your tenant withhold taxes from the rent paid to you?
I'm really not sure.
If they haven't, then fine. If they have withheld any taxes out of the rent that they paid to you, then again your obligation to file tax return comes up.
And that comes with a benefit. You can get the refund of all those taxes. Whoever withheld, if you are not following the maximum maximum allowed exempted limit, that is
even up to 700K can be tax exempt.
Tax exempt. So you